Hello investors, it's Zil from Equitymaster bringing you investing insights to make investing simple and easy to learn. To stay updated on investing trends and the latest developments on Indian markets, don't forget to subscribe to this channel and like this video. Here's the irony. Markets have a habit of appearing predictable just before they stop being so. After a phase of strong returns, Indian equities have entered a period of correction and increased volatility. Indices have slipped from recent highs as global uncertainty, interest rate worries, and intermittent foreign investor selling begin to influence sentiment. During such phases, investors tend to shift their focus. When stock prices are reaching new highs, investors often tend to ignore valuations. But when returns become uneven, the importance of cash flows and balance sheet strength becomes key. This is the time dividend-paying companies attract more attention. Businesses that can continue distributing cash even while navigating economic uncertainty often operate with relatively stable earnings profiles and better capital allocation. Dividends also provide investors with a decent return that is not entirely dependent on market movements. This is important as over time, dividend income can contribute significantly to total returns. In this video, we look at 5 dividend-paying companies that have shown a track record of consistent payouts and have been shortlisted based on filters such as positive sales growth over the past 3 years and dividend yields above 3%. Before we move on, please note this video is for information purposes only. It is not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. With that disclaimer out of the way, let's get started. First on our list is Gujarat Pipavav Port. Ports rarely dominate market conversations. They simply move goods, and in doing so, they offer one of the clearest signals of how trade, industry, and consumption are actually behaving. Gujarat Pipavav Port belongs to this quiet corner of the market where growth tends to be gradual but cash flows can be steady. The company operates a multi-cargo port on Indian western coast, handling containers, bulk commodities, liquid cargo, and automobile shipments. The diversified cargo mix helps reduce dependence on any single segment, adding to earnings stability. Such stability has helped the company with consistent shareholder payouts. At the current market price, Gujarat Pipavav's dividend yield is around 5.3%. Recent quarterly numbers reflect the nature of the business. The company's revenue growth of 11% year-on-year was driven by stronger bulk and ro-ro volumes while container traffic remained somewhat soft. EBITDA margins continued to hover in the mid-50% range thanks to operating leverage in port infrastructure. The company's future growth is likely to be incremental, while capacity additions in liquid cargo and improving automobile exports could support volumes. Port earnings are ultimately tied to global trade cycles. Presently, the stock trades at 17 times a discount to its historical average. Next on the list is Gail. Energy companies generally do not offer predictable earnings. This is a direct result of price movements, regulation changes, and global markets' influence on domestic profitability. Gail, India's largest natural gas transmission and marketing company, operates at the center of this complexity. The company's extensive pipeline network spans over 18,000 km, connecting producers, city gas distributors, fertilizer plants, and refineries. This expansive network offers relatively stable transmission income, which is important considering other segments such as gas marketing and petrochemicals remain cyclical. The stable cash flows have enabled the company to maintain consistent dividend payouts. At the current market price, Gail's dividend yield stands at around 5%. The business's Q3 of FY26 performance reflects the mixed nature of the business. Gas transmission volumes showed recovery during the quarter, supported by demand from fertilizer and city gas distribution segments. Meanwhile, profitability was hit by weaker marketing margins and losses in petrochemicals thanks to higher input gas costs. Looking ahead, earnings will depend on the expansion of the natural gas grid, rising gas consumption, and moderation in global LNG prices. The management expects transmission volumes to improve over the medium term as new pipelines become operational. At present, the stock trades at about 11 times earnings, in line with historical valuations. Third on the list is REC. REC operates in a fairly simple but critical part of the financial system. The company finances projects across the power sector value chain, including generation, transmission, distribution, and renewable energy. The business benefits from India's long-term power infrastructure built out while also maintaining a record of consistent dividend payouts. REC's Q3 of FY26 total income rose 10% year-on-year in the first 9 months of FY26. The increase came largely from a higher loan book, which expanded to about 5.82 trillion rupees. Net interest margin stood at 3.52%, slightly lower than the previous year. The change largely reflects a marginal increase in the cost of funds compared to loan yields during the period. Growth visibility remains strong as per the management. It expects its loan book to expand at 11 to 12% per year on the back of continued investment in India's power infrastructure. Over the long term, REC aims for a total loan book of around 10 trillion rupees by 2030, with renewable energy expected to contribute roughly 30% of the portfolio. The stock currently trades at around 5 times earnings, a tad discount to its long-term median multiple. Fourth on the list is Cyient. Cyient operates in the engineering services space. The company operates in sectors such as aerospace, rail, utilities, and communications. It supports product development, network engineering, and digital transformation programs. Cyient continues to reward shareholders through regular dividends. At current prices, the stock offers a dividend yield of 3%. This offers limited but visible income support while investors wait for a clearer earnings upcycle. In the December quarter, revenue in the core engineering services segment grew about 1.9% sequentially in constant currency, suggesting early signs of demand recovery after a period of muted client spending. Segment revenue stood at around $167 million during the quarter. Margins improved. The EBIT margin in the engineering services business rose to around 12.4%. This came on the back of cost optimization efforts, partly offset by wage hikes and an unfavorable project mix. At the group level, however, earnings growth remained constrained by one-off regulatory provisions and softer performance in certain verticals. Looking ahead, growth visibility is likely to improve gradually rather than sharply. Management expects demand traction to be supported by a strong deal pipeline, increasing contribution from key accounts, and continued investments in semiconductor and intelligent engineering capabilities. However, the pace of recovery will remain linked to global industrial spending cycles. Currently, the stock trades at about 17 times earnings, a discount to its historical valuation. Last on our list is Hero MotoCorp. Hero MotoCorp is India's largest two-wheeler manufacturer, primarily focused on commuter motorcycles and entry-level mobility solutions. The company designs, manufactures, and sells motorcycles and scooters across domestic and export markets, supported by one of the widest dealers in the country. The two-wheeler industry tends to move in line with rural income trends, fuel prices, and entry-level consumption demand. In this environment, Hero's strong presence in the commuter segment provides scale advantages and relatively stable cash flows, despite periodic demand slowdowns. This stability has helped Hero to maintain a consistent dividend payout track record, and at current market levels, the stock offers a dividend yield of around 3%. Hero's Q3 of FY26 revenue growth came in about 21% year-on-year. This was supported by a healthy volume growth of 16% and better realizations. EBITDA margin stood at around 14.7%, expanding marginally on a yearly basis despite higher raw material costs. Management expects industry demand to remain supportive in the near term, aided by rural recovery, wedding season purchases, and new product launches. Export volumes have also grown strongly, rising over 40% year-on-year, though from a relatively low base. The stock currently trades close to its long-term average valuation levels. So to conclude, dividend investing is sometimes viewed as a defensive strategy. In reality, it reflects a certain investment approach that values cash generation, balance sheet prudence, and steady compounding over quick gains. That said, dividend yield alone should not drive investment decisions. Usually, high payout can occasionally indicate limited reinvestment opportunities or cyclical pressures on the business. Sustainability of earnings and free cash flow remains the more reliable indicator. As market cycles evolve, dividend-paying stocks can help bring stability to a portfolio. They may not always deliver the highest short-term returns, but the combination of periodic income and gradual earnings growth can contribute meaningfully to wealth creation. That's it for today. Don't forget to like this video and share it with your friends and family and make them as smart as you are. This is Zil from Equitymaster. Thanks for tuning in.